All right.
Hi, I'm Larry Raymer. I'm a writer for Insider Monkey. It's been a very volatile time for oil prices, and the outlook of US solar stocks is very uncertain. As a result, many investors may be wondering whether it's a good time to buy stocks within the energy sector, and they may be curious about the factors affecting the sector's outlook. They may also be curious about which billionaires have bought energy stocks. Here to provide us with all that information is another Insider Monkey writer, Sultan Khalid. Sultan, thanks for doing a lot of research on the space and for being here
My
to provide
pleasure.
us with the information.
It's my pleasure.
Very good. So, can you describe the factors that led to oil prices' recent surge and subsequent decline?
Yes. So oil prices in general have been down so far this year compared to the last, because of an increase in supply, because of the prospects of an economic slowdown, primarily due to President Trump's tariffs, and because of a global transition towards green energy. However, last month we witnessed a sharp surge in crude oil prices because of the Israel and Iran war. Now, there were some serious concerns about global supply chain disruptions. There were fears that Iran might put a blockade on the Strait of Hormuz, which is responsible for supplying about 20% of the global crude oil and natural gas supply. But ever since the de-escalation, things have calmed down and prices have come down again.
How have energy stocks in general and oil stocks in particular performed recently?
So I mean, we've seen that the S&P 500 hit record levels at the end of the first half, but the energy stocks are lagging behind. Now I'm quoting figures from the 2nd of July. The energy sector was down by 1% since the beginning of 2025, compared to gains of around 5.6% by the general market. So they are lagging behind the wider market right now. And as for oil stocks, now that, like I said before, that oil prices are down compared to last year. They're down by almost over actually 20% since last year. So since crude oil prices are down, oil stocks are also not performing that well. So we've seen stocks like Chevron and Exxon that are below their last year levels currently.
They've definitely underperformed the wider market.
Yeah.
How do you think geopolitical factors will affect oil prices and oil stocks going forward? And do you foresee a ceasefire or a peace deal between Russia and Ukraine or the US and Iran? And how do you think such deals would affect oil prices and oil stocks?
So before we discuss that, I think we should discuss OPEC Plus, the group that's responsible for producing around half of the global oil supply. Now, OPEC Plus, after years of supply cuts, they are now focusing more on increasing production. They did that in May, June, July, and now they're also about to do that in August, probably. So right now there is increased supply in the market. And now, if we see a peace deal between Russia and Ukraine, which I hope we do, Russia is a major oil producer. And if it manages to sign a peace deal, it will have easier access to markets, which means more supply. The same goes for Iran. It's a huge oil producer. And if it manages to sign a deal with the US, which I hope it does, we'll have another major producer entering the market, which means more supply again, and more supply means lower prices.
And what do you think the best parts of the energy sector to invest in are now? And would you actually recommend that investors put their money to work in those parts?
So while the overall energy sector has been lagging behind the market, there are some subsectors that are performing well that seem bullish right now. One of them is natural gas. Now, natural gas prices have been up by 40% compared to last year because of increased domestic consumption, exports that are outpacing supply. One of the factors that is driving this growth is LNG, liquefied natural gas. The United States of America is currently the largest LNG producer in the world. It's also the largest LNG exporter. So, Such high exports are driving growth in the sector. And another major growth factor for natural gas is the current AI boom. So gas has emerged as a primary candidate to power this AI boom and its uh, hungry data centers because it's relatively cheaper, it's cleaner, it's more reliable, it's abundant. So this is amazing. So we have several gas-based power plants that are going to come online in the US in the coming years, which is a very big growth factor. And then the second subsector would be, I think, nuclear. Now, nuclear had been on a sort of a back burner around the world since the Fukushima disaster in 2011, but the sector is witnessing a big renaissance right now. Even President Trump, in May, he signed an executive order to quadruple the American nuclear energy capacity by 2050. And then the private sector is also very interested right now. We saw big tech that met on the sidelines of the CERAWeek conference back in March, and they signed a pledge to triple the global nuclear capacity by 2050. We've seen tech giants that are now signing contracts with energy providers for nuclear energy. We've seen Amazon with Talon Energy, we've seen Microsoft with Constellation Energy, and then also uranium prices are up by around 23% since March. So this sector seems really bullish right now.
So would you recommend that investors look to put money to work in the natural gas and nuclear stocks?
That's what I would suggest. Yes, they look better than other sectors right now when it comes to energy.
You think that'll the data centers will be needle movers for those companies?
Oh yes, definitely.
And what impact do you think the global energy transition is having on oil prices, and in particular, the proliferation of EVs and plug-in hybrids, especially in China?
So the International Energy Agency, it expects global oil demand to peak and then plateau by the end of the decade. China, which is the largest oil importing country in the world, its oil demand is expected to peak 2 years earlier than expected, actually, in 2027, because of its transition towards electric vehicles, because of the high popularity of LNG powered trucks, because of its high-speed rail network, because of structural changes in its economy. And then on the other hand, the IEA expects the rising supply to outpace demand growth in the coming years. So we will witness, in general, a decrease in demand or a decrease in demand growth, which should also put pressure on prices. However, in the long run, if we witness any supply chain disruptions like we did last year, then we could witness an increase in prices again. But if there are no supply chain if there are no supply chain disruptions, then prices are expected to come down.
I understand. How do you think the performances of the US and Chinese economies will impact oil companies and oil stocks?
So China and the US, they're the two largest economies in the world. They're the two largest oil consumers in the world. They have trade that ranges in hundreds of billions of dollars, and their economies are very dependent on this trade at this point. So if we witness a sustainable peace deal between these two countries, which again I hope we do, their economies will grow and they'll be healthy. So, and healthy and growing economies need a lot of that and a lot of energy. And a big portion of that energy is expected to come from crude oil. So that will support prices.
And moving on to specific companies, Exxon, of course, is one of the world's largest producers of oil. Can you tell us its situation now and what it's doing to deal with the relatively low and volatile oil prices?
So Exxon is a behemoth of the global oil industry. It has a vast global presence, which actually gives it a significant competitive edge. It has very deep pockets, a very healthy balance sheet. It managed to surpass expectations in the first quarter. The company has grown its earnings at an annual rate of roughly 30% over the last 5 years, while its cash flow has increased by a CAGR of around 15% during the period. So it's a company that's doing very well at the moment financially. It has it keeps its shareholders very happy with very high shareholder returns. It's a dividend aristocrat, and it's aiming for around $20 billion in stock buybacks annually. So, such high levels of shareholder returns to make them sustainable, especially in this low price environment, the company needs to adapt, which it is actually doing. One way of doing that is by reducing costs. Taken around $12.7 billion of structural costs out of its business since 2019. The company has sold around $24 billion of non-core assets again since 2019. It's aiming for low break-evens. It's targeting a break-even of $35 by 2027 and $30 by 2030. So it's very highly focused on efficiency and cost saving right now to make sure that it can survive and thrive in this low price environment. And then it understands that to be able to survive in the long run, it needs to diversify away from oil, which it is doing slowly. And a great example is its Golden Pass LNG project that it co-owns together with Qatar Energy, and the project is expected to start producing LNG by the end of this year. And Chevron is a big favorite among billionaires. So one of the biggest investors in the company. So Insider Monkey, it has a database of hedge funds and billionaires. We track their portfolio movements and we provide them to our readers. So for Exxon, we have Ken Fisher's Fisher Asset Management that held a stake of $3.6 billion in the company at the end of the first quarter, 2025. And then there was also Rajiv Jain's GQG Partners that held a stake of almost worth $1.2 billion.
Wow, very good. And moving on to our next company, a very famous multi-billionaire investor owns a lot of its stock, talking about Occidental, of course. And can you tell us more about that investor and what strategies Occidental is using now?
So Occidental is another big hydrocarbon producer, not as big as Exxon, but so it operates in the US, Latin America, and the Middle East. Now, the company is special because it has received the stamp of approval from Warren Buffett himself. Berkshire Hathaway bought a stake in Occidental Petroleum back in 2019 and has consistently increased this stake since then. Currently, it owns 28.2% of Occidental. Even despite owning such a large stake in the company, Warren Buffett has made it very clear that he does not intend on completely acquiring the company. It just represents his long-term stake in the future of oil and gas. Now, Occidental, unfortunately, it hasn't been doing very well lately. The stock is down by around 30% since last year because of high debt costs, because of environmental liabilities, and the overall market volatility. That said, Occidental boasts some very high quality and low cost assets. It's working very aggressively on efficiency, so well that it can keep itself cash flow positive, even with oil prices in the low 30s. And
Um,
the company has been struggling with debt, but it's dealing with it now. Occidental has repaid $6.8 billion in debt since the third quarter of last year, saving it around $370 million in interest expenses. So this efficiency and these low costs, low interest costs should enable it to survive in the current environment. And then the company is also diversifying. It has a midstream segment, a chemical segment that are doing very well. It has also emerged as a leader in carbon capture technology. Its flagship Stratus project is expected to come online by the end of this year.
you
And
think that will generate, I'm sorry.
we have Berkshire Hathaway, that is a major investor in the company. After that, we also have Prem Vatsa's Fairfax Financial Holdings that holds a stake almost worth $300 million at the end of the first quarter 2025.
So a couple of very large investors have a significant amount of
Yes,
its stock.
absolutely.
And do you think carbon capture can be a positive needle mover for the company?
Yes, I think oil producers have to diversify, and the world is moving towards greener energy. So they have to learn to adapt, and they're doing that step by step. They're taking their time, but they're getting there.
Okay, and finally, we're going to move on to a very different type of company and a very different part of the energy sector. And that's First Solar, one of the largest producers of solar panels. And what do you think its outlook will be after the Republicans look poised to take away all of these solar energy tax breaks in the US?
First Solar is another incredible company. It is the largest solar manufacturer in the US and the Western Hemisphere. The company has invested billions of dollars to develop a very strong domestic manufacturing base, which proved very handy actually also during the recent tariff wars. It's a very innovation-based company. Its solar panels are low cost, high quality. They work well in difficult environments, and they're very suitable for utility scale projects. Now, as is the case with the rest of the solar sector, First Solar is also very dependent on solar tax credits that it got during the 2022 Inflation Reduction Act in the Biden era. And around 60% of its income actually comes from these credits. Now, as we all know, President Trump is not a big fan of solar and wind, and he decided to do away with these credits in his sweeping tax and spending bill, which has actually caused a lot of volatility in the sector over the last few weeks, and First Solar hasn't been an exception. Now, recently we learned that the US Senate has passed a version of the bill. Now, this version that was passed by the Senate was actually more flexible than some of its previous versions, but still, it has decided to eliminate those tax credits sooner than expected, which represents a major headwind for the sector in the coming years. Uh, Now, that said, I mean, the bill is headed back to the House, so we'll see how it turns out in the end. But my opinion is that these credits are going to go, and they are going to go sooner than everyone has expected. Now, um, this could also be an opportunity in disguise, I think, for these companies. These credits were going to go sooner or later, and these companies would have had to learn to survive without these credits in the long run. They cannot always depend on subsidies, major subsidies from the government. So I think we'll see a lot of consolidation in the sector in the coming years. As for First Solar, I think it has a lot of things that are going in its favor. Now, like I said, the company has a very strong domestic manufacturing base, which make it more competitive in the US market when it comes to deliveries and when it comes to pricing. It is the only fully vertically integrated solar manufacturer in the US. It can go from raw materials to finished product in only 4 hours. And then I think we all know that solar is here to stay. It's an integral part of the US energy mix at this point. It is the fastest form of new energy. And First Solar caters primarily to utilities. So the AI boom and data centers represent a major growth factor for the company. And then the ESG mandates from hyperscalers like Amazon and Google, that's also a significant opportunity. So and then it's a very innovation-based company. Its proprietary CDTE technology is superior to the Chinese crystalline silicon technology. It's low cost. It works well in difficult environments. It's just a more superior technology. And First Solar has been known for its innovation-based culture. So the company has a lot of very good cards that it can play despite some major headwinds in the coming years. And if it plays those cards well, I think it should come out stronger than ever.
Very good. And thanks very much, Sultan, for all the great information. We
Always a
appreciate it very
pleasure.
much.
Always a pleasure.
Thank you. Bye
Thank you.
bye.